Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Lesso Group Holdings Limited annual report. China Lesso Group Holdings Limited offers a diverse range of businesses and services across various industries. At its core, the company manufactures piping and building materials for municipal engineering, including pipeline system solutions, water and power supplies, and drainage systems. In addition to these products, China Lesso also provides specialized solutions for specific sectors such as agriculture, mining, chemicals, food, oil and gas, and industry and commerce. These include water-saving irrigation systems, aquaculture platforms, and firefighting pipelines. Beyond manufacturing, the company is involved in various other businesses including property development, e-commerce platform services, logistics and fulfillment services, and power generation technical services. It also offers internet data services and holds sports events. Furthermore, China Lesso engages in property investment, manufacture and sale of building materials such as aluminum profiles, monocrystalline silicon, fertilizer, and chemical products. The company's product offerings are diverse and cater to a wide range of customers, including independent distributors, civil contractors, property developers, utility companies, and municipalities. Overall, China Lesso Group Holdings Limited is a multifaceted conglomerate with a broad portfolio of businesses and services that span various industries and sectors. China Lesso Group Holdings Limited market capitalization of 14 billion is significantly larger than the average industry peer of roughly 0 billion. This shows that China Lesso Group Holdings Limited holds a significant advantage in their industry. China Lesso Group Holdings Limited trades at a higher price-to-earnings ratio of 7 times and a lower price-to-book ratio of 0.51 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 58% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 4.32%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth and decline can be identified from various business segments. On the growth side, the sale of building materials and home improvement products saw an increase of 8.3%, while contract revenue from renovation and installation works rose by 6.9%. The income from environmental engineering and other related services also experienced significant growth, particularly in new energy businesses, with a 153.5% increase. Additionally, logistics and other related services contributed to the revenue growth, with a 6.9% increase. Rental income from investment properties in Asia, North America, and Oceania saw a notable 19% year-over-year (YoY) increase, while rental income from operating leases with tenants rose by 35%. These segments collectively drove revenue growth. On the other hand, contract revenue from renovation and installation works declined by 20.6%, and income from environmental engineering and other related services decreased by 18.5%. These declines were significant contributors to the overall revenue decline. The net income and profit margins of the company underwent significant changes in recent years. The net income decreased by a substantial 25.1% to RMB 12.62 billion, primarily due to industry-wide challenges, slowdown in project implementation, and fiscal pressures on local governments. A closer look at the profit margin reveals that while the gross profit margin increased slightly from 27% to 27.5%, other margins experienced a decline. The net profit margin decreased from 6.1% to 5%, indicating a reduction in profitability. Furthermore, the EBITDA margin dropped from 17.5% to 16.2%. The reasons behind these decreases are multifaceted. Lower selling prices and reduced gross profit margins contributed significantly to the decline in net income and profit margins. Additionally, revenue decreased by 12.4% from sales of PVC products, while the average selling price of plastic piping products dropped by 9.3%. These factors collectively led to a decrease in profitability for the company. The company's operating cash flow is a subject of mixed signals. On one hand, various pages indicate positive operating cash flow, including net cash flows from operating activities of RMB 4,335,756 on page 104, operating cash inflow of RMB 6,642,551 on page 166, and an increase in net current assets of RMB 2,250,757 on page 266. These positive indicators suggest that the company is generating sufficient cash from its operations to meet its financial obligations. However, other pages present a different picture, indicating negative operating cash flow. For instance, page 210 explicitly states operating cash flow, negative, and page 236 shows a net outflow of RMB 31,350 in investing activities. Additionally, the total decrease on page 241 amounts to RMB 863,948, further supporting the notion that the company's operating cash flow is not entirely positive. The presence of interest rate risk and lack of hedging policies on page 250 also contributes to the likelihood of negative operating cash flow. This mixed evidence suggests that the company's financial situation is complex and requires a closer examination of its operations and management practices to determine the accuracy of its reported cash flows. The company's debt level has undergone significant changes over the past year. Initially, there was a decrease in debt by RMB 2,288,577 on page 98. However, this trend is not consistent, as seen on page 251, where the debt increased by a mere RMB 6232. Furthermore, the breakdown of financial liabilities on page 256 shows an increase in borrowings and lease liabilities. Despite these fluctuations, the overall picture suggests that the company's total borrowings have decreased significantly. On page 227, it is mentioned that the total borrowings decreased from RMB 19,228,819 to RMB 17,540,655, a decrease of 12.9%. This trend is also observed on page 226, where the total borrowings decreased by RMB 2,686,778. In terms of interest expenses, there has been a consistent decrease over the past year. On page 103, it is mentioned that the interest expenses decreased from RMB 951,335 in 2024 to RMB 685,773 in 2025. Similarly, on page 106, it is stated that the interest paid has decreased significantly from RMB 997,982 to RMB 698,619. This trend continues with a further decrease in total interest expenses from RMB 1,057,688 to RMB 767,096 on page 172. Overall, while there have been some fluctuations in debt levels, the company's total borrowings have decreased significantly over the past year. In contrast, the interest expenses have consistently decreased, indicating a reduction in the company's financial liabilities. The financial performance of the company varied across different regions and segments. On a positive note, overseas markets such as Southeast Asia, Africa, South America, and North America performed well, as did core domestic markets including municipal, agricultural, commercial, and industrial sectors. Additionally, southern China saw significant revenue growth, with an increase of RMB 33.482 million to RMB 12,087,219. Outside China also reported a substantial increase in revenue, rising by RMB 1,797,490 to RMB 141,789. In contrast, certain segments struggled. Building materials and home improvement declined by 18.9%, while others saw a decrease of 12.8%. Northern China's performance was also disappointing, with revenue decreasing by RMB 1.634 million to RMB 10,376,152. Furthermore, the Eliminations Consolidated segment reported a significant decline in segment revenue, down by RMB 2,487,865. Management is projecting a positive future for the company, with a focus on advancing major national strategies. This includes infrastructure development and green manufacturing, which will be driven by increased investments in key areas such as pipeline transportation. The company will also undergo structural adjustments to focus on core operations and explore new projects in environmental protection. This shift is necessary due to overcapacity and tight fiscal conditions. In the new energy industry, management plans to expand into overseas markets while maintaining a cautious investment approach. Investments are expected to create long-term commercial synergies, broaden sales channels, and facilitate business diversification. The company also aims to reinforce its market leadership through these investments. Furthermore, acquisitions will enable the company to further diversify its businesses, solidifying its position in the industry. The company's dividend payment history is well documented in its financial reports. On page 4, it is explicitly stated that the company has paid dividends. This confirmation is further supported by subsequent pages, including page 181, which specifies the amount of the final dividend paid out to ordinary shareholders at $0.20 per share. Additionally, on page 208 and page 277, the company's dividend payment record is again confirmed, with no indication that shares have been bought back. Concerns about inventory buildup and supply chain disruption are evident in the extracted summaries. The company's manufacturing and trading inventories have accumulated provisions for impairment and obsolescence, indicating potential issues with inventory management. The raw materials inventory has increased, while work in progress and finished goods inventories have decreased, suggesting a mismatch between production and sales. This could lead to inventory buildup and associated costs. Supply chain disruptions are also a concern, driven by industry overcapacity in environmental protection and new energy sectors, tight fiscal conditions among local governments, and international trade barriers. These factors contribute to weaker operating performance and increased competition. The company's property under development is expected to be completed after the reporting period, adding to potential supply chain risks. The prolonged inventory holding periods of up to 3 years or more further exacerbate these concerns. That concludes the financial summary for China Lesso Group Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.